So good morning. My name is Mike Moe, and I'm delighted to have the opportunity to moderate this panel. We have, in my view, the three top research analysts on Wall Street that follow the education space, with us this morning. I've known all for a very long time. They're exceptional research people and very strategic thinkers. So I'm anxious to hear what they have to say. I'll let each of them give a little bit more of an introduction. But to my immediate left, we have Trace Urdan, who was one of the first people to identify the opportunity in online learning, who's a managing director at Credit Suisse. We have Corey Greendale, who's a senior vice president at First Analysis, who's both been a research analyst and investor in the space for a very long time. And then Alex Paris, the CEO of Barrington Research in Chicago. Again, both analyst and investor, and all with exceptional backgrounds and respect. So maybe I'll give each panelist just a little bit more time to talk about what you're doing, and maybe some of the quick, in a minute, kind of quick thoughts in terms of what you're doing in terms of coverage on the space. I'll start with you, Trace.
Sure. So we call it Knowledge Services at Credit Suisse, and it spans everything from pre-K through corporate, and includes both folks who are providing educational services and those that are providing services to educational services, and it's eclectic. We're talking about software companies some days and services companies other days, but the common theme is the common drivers. Or basically, our thesis is that there's an enormous need for education globally. It's a driver of the economy. It's a driver of people's personal wealth. It's also a driver of corporate wealth, and it's a driver of national success, and that there's enormous need out there, and that government funding alone can't fill that need. Governments are constrained. So whether you're talking about, everywhere in the world, you've got constraints caused by an aging population and the demands of Social Security. You've got rising healthcare costs, and generally speaking, the priorities for most governments are, with providing K through 12 education, sort of basic literacy to their populations, and all the growth elsewhere really is going to have to come from the private markets in some way. The private capital is still needed in this space desperately, and I would also make the assertion that any innovation that's happened in this space for the last 30 years has come as a result of private enterprise and private investment. That's none of those are controversial statements at this gathering for sure, but believe me, elsewhere you can get into, there can be fisticuffs over statements like that. So anyway, that's the core kind of our investment thesis, and I try to tackle it from every angle I can come at it from.
Corey.
Corey Greendale from First Analysis. We're a little bit unusual in that we do two things that are ordinarily separate. We both provide coverage of public companies. We also have venture capital funds where we make direct investments in private companies, and we do very deep research into specific industries, and I spend the vast majority of my time on what we call human capital and human capital technology, which is education and HR related areas. And our view, I guess our thesis, is that there's sort of this artificial barrier between school and the workforce. That barrier is increasingly going to come down for both kind of social and technological pressure reasons. And we're making investments in covering companies that are playing to that thesis. So in public coverage, it's everything from K-12, provider of technology for the K-12 system, through the post-secondary providers, through the technology providers like 2U, Instructure, Chegg, and then we also cover the human capital like HR technology companies like LinkedIn and Workday. We also make direct investments throughout those areas, including a K-12 technology company called Learning.com, a high school dropout recovery called Advanced Path, a post-secondary provider, low-cost degrees called University Now, a recruiting technology company that helps Fortune 500 companies recruit talent directly out of college called Yellow, And then our most recent investment is entirely in the HR space, a talent management technology company called NetCheck. So the fact that we have both of these focus areas allows us to kind of see on the horizon what's coming up that's helpful for covering public companies, because we see what the kind of smaller private companies are doing, and vice versa. Understanding what's going on in the public markets is helpful for our venture capital investing to understand kind of where the gaps are, ultimate acquisition opportunities are, and where things may be helpful from a strategic fit perspective.
Alex.
I've been covering education for over 25 years. You know, from a top-down perspective, we look for big markets, big opportunities, and profitable solutions to those big problems. And long ago, in the late 80s, we identified education as one of those industries where we could maybe make some money for our investing clients. Our clients are institutional investors, and at Barrington Research is the core of what we do, and we're trying to help institutional investors make money. So we started in the K through 12 area. We started in ed tech, really. We covered a little company called Plato Education in the late 80s, and Jostens Learning. Jostens, the class ring maker, had a really exciting technology product in the late 80s. Then I found a little...
How old are you?
I was going to say.
That's when I started. I started 4 months before the Black Monday of 1987, so I was looking for companies with recurring revenue models and things like that. So we got into DeVry, a suburban Chicago located company that nobody knew about and everybody pronounced DeVry at the time. We eventually covered all the post-secondary education companies, had a great run for 15 years. At its peak, Apollo Group was up about 17,000% from its IPO price. And still today, even though it's depressed, it's still up 700 or 800%. But we too have expanded our coverage into ed tech companies. We cover 2U, Chegg, Instructure. We cover corporate training companies, and we're looking for other money-making ideas for our institutional clients.
So Corey, you talked about these artificial barriers between schools and work. Talk a little bit more about that, and then talk about your most recent investment and why you guys made it in the talent management space.
Yeah, sure. So we've been doing, so the approach we take to investment markets is we'll try to get a lay of the land, and we'll often publish a white paper associated with that. So talking to a lot of ed tech companies, we heard a lot of the same kind of conversations that, you know, we're providing learning, but the real sort of value ultimately is how do we get these people good jobs. So we saw that from looking at the traditional post-secondary providers as well as from technology companies. Published a research report on talent acquisition technology that was kind of a taxonomy of the landscape, and saw that there, I can talk at a very high level, there's sort of these demographic and socioeconomic trends that you look at the number of people, the number of job openings relative to the unemployment and underemployment rate for people right out of college. There's clearly this mismatch, and there's a lot of reasons for that, and part of it is, as all of you know very well, there's the skills gap. There's also the fact that companies don't always know where to look to find the right talent. So that thesis kind of gelled around the idea of finding companies that are helping bridge that gap. So the company we invested in specifically, Yellow, their claim to fame was that they were the largest provider of software that Fortune 500 companies were using to recruit out of colleges. They've expanded well beyond that to doing more professional recruiting and talent relationship marketing, basically applying techniques from Marketo and marketing automation to recruiting, since recruiting really is marketing. Extending beyond that, this most recent thing, NetCheck, it's a provider of payroll technology. It competes with like Paycom and ADP and people like that, if you're familiar with that. But all of that, the thesis is that technology is allowing within the enterprise everybody to become users of HR software. It's not just the HR person. And there's all sorts of value you can create if you provide sort of mobile enabled. How do you ask for time off? How do you clock in? So it's really extending that thesis and measuring, finding the right person for the job and effectively helping them develop as they continue.
And just quickly, how do you guys find this company to invest in? How did you find Yellow? Was it from a list talking to employers? And then hearing this Yellow come up over and over again?
Well, that one specifically, this is not, I mean, we invest thematically, not geographically. They happen to be based like 3 blocks from our office. So that worked out well. But they were one of probably 50 or 60 companies we profiled in this report, and it's one that we found particularly interesting. But when we first started talking to them, actually, it was too early for us. But they stayed in touch because they were getting our reports all the time, and we sort of became strategic advisors. And then when they were looking for an investor, they came back to us. The other one that I mentioned, NetCheck, this was a deal that's led by a larger private equity firm where they knew that we have knowledge of the space, and they invited us to participate.
Great.
In the round.
So Trace, you were super early in the online education wave. and they put out a great white paper. I don't even know what year it was, but it was very, very early days. What do you see today? What trends are you seeing? What are you most excited about?
Well, it's funny. I too am particularly excited about that that space between, sort of where education ends and employment begins. It seems incredibly inefficient, and when I think about the really big opportunities that touch on education, sort of solving what is a really backward way that we still have of identifying candidates and hiring candidates, to me, seems like one of those enormous opportunities. And I think that on the education side, these are themes that we've heard, I'm sure are being talked about in other rooms right now. But the idea that there's enormous opportunity for education to become more focused on providing, the skills that are needed for employment, for doing it in different ways, for innovating, both in terms of the product offerings and the business models, and even here at the conference, I've heard about new verticals that are being developed in that space, and I find that incredibly exciting. The idea that sort of consumers paying money out of their pocket to get a product that they feel strongly about is working for them, and that employers need, seems like a big idea. I think that the notion that there could be at some point in the future a marketplace. I think LinkedIn has this concept down, but I know that there will be others where you can sort of bring buyers and sellers together in a way that's more efficient than where did you go to school and and how many bullets are on your resume. That to me seems like a really big and compelling idea.
Great, Alex. So you talked about being involved with a lot of the service providers, the Apollo groups and DeVry's of the world. Yep. What do you see as the next wave? What are you focused on, and where do you think the big opportunities are going to be created in this space?
Well, I like what's going on, within post-secondary education today. They're clearly bouncing along the bottom. The valuations on these companies reflect that. Rather than getting 3 and 4 multiples on revenue, like some of the ed tech companies are getting today, these post-secondary education companies are getting 0.2 and 0.4 times revenue. There are some higher performers that are doing better, like Grand Canyon, Capella, the top performing companies in that group, but all of the companies have gotten better as a result of the scrutiny. That what does not kill you makes you stronger. But they're also looking for other non-traditional ways to generate revenue growth and non-traditional revenues. DeVry and Strayer both got into the business of acquiring, coding academy sort of companies. They're all getting into adaptive learning one way or another, and they're all doing these things from really low valuations. So, moderate success could result in significant return on an investment. But we've also wanted to leverage our investment in education and over the last 25 years by broadening it into education technology. And education technology, as you all know, is an exciting, fast-growing area, and it's more accepted than ever before within academia. When I covered those companies that I mentioned earlier, like Jostens Learning and Plato, there was a great resistance on the part of faculty and teachers and professors, to introduce technology into the classroom. And now there's a acceptance of it. It's a tool. It's not a replacement. They don't take offense. So we're looking for ideas within education technology, and we're getting lots of neat ideas through the public market, but also through the private sector, attending conferences like this and visiting other companies as well.
So Alex, I want to talk specifically public companies, and let's talk about one. I want to hear your best idea in the public market, with the exception of GSV Capital.
Right. So I cover GSV Capital also as a broad-based,
and very sincerely, very well, and we're very appreciative. Thank you.
In the interest of full disclosure, I broadly cover consumer and business services, and we look at GSV as an opportunity that way, and also to learn a lot about education technology and the other areas that GSV focuses on. Within ed tech, I love the visibility, the predictability, the outperformance of 2U and Instructure. An investor could make the case that that's reflected in the stock price at 3 and 4 times revenue.
Somewhere, so I don't know from 2U, but go ahead.
Oh yeah, Chegg is a very misunderstood company in the investment world. It, unlike Instructure and 2U, is trading at a little over 1 times revenue, EV to revenue. And the reason for that is because they're cycling out of the print textbook business, which is a business of yesterday for this company. I'm very excited about the businesses of tomorrow within Chegg, and I think the price that you're getting, the entry point you're getting at Chegg at $4.50 or $5 a share does not reflect at all the potential upside of a very clean ed tech company in 2017 and beyond. So I like Chegg on a risk-adjusted basis. I'm a two-handed economist sort of guy, so on the one hand and on the other hand. But I do like, I think the multiples that 2U and Instructure get are deserved, because it's going to be very difficult, in my opinion, for them to miss earnings expectation over the foreseeable future. And you pay for that comfort and security.
So Corey,
Yes, sir.
you don't get 3 choices.
I was going to say, you're never going to nail him down to 1.
Well,
What's your best public company?
And the problem is our compliance person gets mad if we say, like, here's our best choice. But I will say,
you can do whatever your compliance officer allows you to do.
So, and I don't want to just say.
I miss the good old days.
Yeah, exactly. I don't want to just say, like, I agree with Alex, because that would be boring. But so a couple of points I'll make. First of all, you have this massive disparity in the markets where, as you mentioned, the post-secondary companies are trading like they're going out of business, kind of across the board, and then some other companies are getting very high multiples. What's interesting is you're almost seeing this convergence between, take like Capella, for example, which now has a partnership with Career Builder, is doing all these things to deliver education in a much more surgical way than only offering full degree programs, and targeting it to job seekers and people within companies who need a specific skill to move up. That is a pretty good description of what LinkedIn is doing with lynda.com. Now, LinkedIn's valuation is pretty different. Now, I don't know how closely everyone follows this, but it got absolutely crushed this last quarter for reasons unrelated to Lynda. But nevertheless, it trades at a very different multiple than Capella does. And some of that is investors look at growth. It has a different growth rate. But if you look kind of thematically, I think you're going to see more of a convergence between some of these older companies, what are viewed as older models, as they are smart people and evolve toward some of these other opportunities. So more specifically, we also are big believers in 2U. I think that it's great that they're public. I think that their coming public is going to be helpful to a number of others in the space. It's a very powerful business model. It's not a trivial business model to explain. And I think they've done a phenomenal job of that. I think there's still some inefficiency in the way it's priced based on some lack of comprehensive understanding over how that model works. And I think if investors take the time to kind of understand how each program works, the challenges that universities would have if they were to not work with 2U once they've been working with 2U, and you look at kind of the cash flows, that there's a lot of opportunity there as well. In Instructure, structurally, they're winning a disproportionate number of deals. It's a well-defined market, a very strong product, and I think they've got a great runway. And agree with you on Chegg as well, that there's a big opportunity there that investors, it's somewhat of a complicated story because it was a textbook rental company. Investors kind of think of it that way. They're transitioning. If you look at the top line, it's actually shrinking this year. But if you kind of look beneath the surface to the higher margin, more kind of online digital products, that's growing strongly. And over time, we think investors will. It doesn't screen well, as we say in the business. Like investors will look just at a top line growth number, and they'll just, if you're a growth investor, you won't even spend more time on it because it looks like it's shrinking without taking the time to understand. And as that becomes more visible, we think that it will start getting more of a multiple commensurate with the growth and business model that it deserves.
So your compliance officer should be very happy because I asked for one idea, and I think you had consensus with Chegg, 2U, and Instructure being great ideas. It sounds like LinkedIn's pretty interesting too, with it being crushed, and Capella, of course, is doing what LinkedIn's doing, but doesn't have the same multiple. So it's perfect.
Yeah.
I'll talk about one name. So I cover a name these guys don't cover, I think. I cover Houghton Mifflin. So Houghton, to me, is really compelling for a number of reasons. Just on a near-term basis, you're looking just structurally at a textbook adoption market that gets a lot stronger in 2017 and even stronger still in 2018. So that force alone should lift it. But more thematically and long-term, I think they have, you have a management team that came in a couple of years ago, a lot of smart folks from Microsoft, and they've really revamped the development process internally there, where they're really platform agnostic, and they've embraced digital content, and digital content becomes a really compelling driver of the business model of the story, where they've managed to maintain the same price point with digital product, and yet it is, there are all kinds of cost savings associated with the transition from one to the other. At the same time, I really like them, and this is maybe a more controversial statement at this event, but I meet a lot. I'm in California, so I get this even more maybe than these guys do. I meet a lot of recently started companies in the K-12 space, and I have to be really careful because they sort of talk to me like I'm some kind of a Luddite defending the newspaper industry, right? When I talk about how difficult it is to make a fundamental change in the K-12 marketplace, because they have this idea that at some point the force of these viral products that a lot of them developed, and some of them really are compelling and very viral, are going to kind of break down the old funding models in K-12, and funding is going to kind of flow to teachers, and teachers are going to act like consumers, and we're going to turn this whole industry on its head. And I'm open to that, because I think you'd be an idiot not to be open to that. But at the same time, the way that schools are funded in this country is fundamentally different from the way the music industry works and the newspaper industry works, and you have a really political operation where the people that are in charge are really held accountable for one thing, which is rising test scores. And if you don't make those test scores go up, you're out. And so there's a high degree of risk aversion, and there's a reason why there's so much business concentrated in the few publishers. So one of the reasons I like Houghton Mifflin is because I really see them as an ed tech play that's available in the public markets, because I think they will ultimately be the owner of some of the most compelling companies that you might see at this event today, because they actually have a way to monetize that content and that energy. And we can get into discussion of open education resources. I'm still a little bit skeptical there, although I think there's a way for them to co-opt that as well. So I really like Houghton as an ed tech play. I think the people that are running that company are really smart about ed tech. I've never been able to stump Linda Zecker on the tiniest K-12 company out there. She knows them all. Anyway, so there's a new name.
And you're an old media guy. You started your career at Times Warner, if I remember correctly. Well, talk about the public markets, though, in terms of, evaluating the proprietary post-secondary schools, like they're going out of business. You said it. The publishing companies are kind of valued somewhere not going out of business, but the models are changing.
Right.
And then the tech companies like Instructures in 2 years of the world have healthy multiples to them. Is the public market right, and is it accurately forecasting kind of what's going on? What has the public market got wrong, and what has it got right? Corey.
So investors, this is going to be a gross oversimplification, but a given sort of investor on the buy side, they've got to look at a lot of different things at once, and you get into this life is too short phenomenon. So when the post-secondary space was healthy, it was a great area for a number of reasons. These were very kind of easy to forecast businesses, great visibility, profitable. Students don't come out of the money; it wasn't out of their own pocket, so that was beneficial for the business models, and they pay ahead of time, so you get the money before you provide the services. And there were flavors for every investor. There were the very large cap companies like Apollo. There were smaller cap companies. There were growth companies. There were more kind of steady cash flow companies. So most investors owned something in the space, or I don't know, many investors own something in the space. What's happened is it's not just the fundamentals. It's just after we've been through all these kind of regulatory pressures and issues, we went through a cycle where someone in the department would kind of move their head the wrong way, and suddenly stocks would be down 8%, and our phones would be ringing off the hook like, what's going on? And we found out some deputy undersecretary had spoken at some event and said like one sentence about something. Investors, that is a tough thing for the public markets. So it's not exactly like that anymore. It's kind of calmed down and people are more used to it. But having been through that, you have this long memory, and the post-traumatic stress stays with people. So because of that, I would argue that in the post-secondaries, there's stuff that is underpriced. But the question is what's going to change that. And you probably need some more time. You need to see more of the company's performance improve. You're starting to see some that are showing at least new student growth. But if you kind of take it all on average, it's not growing yet. And people need to understand, feel comfortable with the political environment, that somebody isn't just with, going to wake up on the wrong side of the bed and suddenly your entire business model is at risk.
Yeah, and just a quick comment, let both of you answer. So if you didn't see Dan Rosenzweig's Chegg presentation yesterday, again, I think it was provocative, whether you agree with it or not, but it was a great presentation, so watch it on a video. But what made me think of it is you made the point about your phone ringing off the hook. Yeah. One of the great stats that Dan had yesterday was something like 50% of today's high school students don't even know they have a home. The phone, when the phone rings, the regular phone rings, they're like going to panic because they don't know what it is, because nobody uses a regular phone anymore. Anyway, Alex.
The other thing I was going to add to what Corey had to say, and I agree with what Corey said, that there's, at one point, pretty much every growth investor owned Apollo or DeVry or ITT. And at their peak, I think, as I recall, they traded at 38 times forward earnings and 19 times forward EBITDA, in the mid-2000s. Now that it's completely turned over, the growth investors are clearly not in the group because they're not growing. And value investors are starting to poke around, but they're looking at these things saying, 1 times EBITDA, what am I missing?
Yeah. I think
even
they
can't get
been burned on the way down,
right.
and that's part of the problem, right? So we've had a lot of false bottoms. So
that's and false, knee-jerk sort of reactions where they start to report new student starts. So you think it's the bottom. They report a couple of good quarters, and then it takes a turn to the south again. So I think we're starting to see them finally. The comps are easy enough. I think they'll start to work their way up. Now, on the other hand, investors in Instructure and 2U, they tend to be growth investors, and they're more comfortable at looking at companies on a revenue multiple, and they're more comfortable in investing in companies that are high growth. So you have that bifurcation of valuation.
So is the public market right? I mean, is the public market getting this right, or what are they missing?
I would say that part of the challenge, Mike, is that you don't have a lot of lines being drawn connecting the dots here, right? I mean, I think to some extent, 2U and Instructure and even Chegg are kind of bluebirds. Like there's not. I find that the opportunity for evangelism comes from trying to educate investors that this is part of an ecosystem that has some cohesion and some relation. Like I think that there are 2U investors who've got no clue what Chegg does, and Chegg investors have got no clue about 2U. And the 2U investors, it's like the old days of Blackboard. Like those guys are invested in a bunch of other software companies. They're not, they like what they know about post-secondary education is what Chip decides he's going to tell them. Which is fine because Chip's a good guy, and I don't think there's anything wrong there. But they don't connect the dots there. That we don't yet have, although maybe we're close, and hopefully we are. We don't yet have an ed tech investor in the public markets the way we do, clearly, in the private markets.
So tell me who are give me one investor or maybe two that are the smartest public investors that you guys come across.
You're definitely not going to answer that question.
You love, oh, come
no
on.
way.
Oh, come on, you love
no
all your, no, we'll take me out of the pictures. No, you love all your clients, but somebody that you say, okay, these guys are connecting those dots. Interesting. Go ahead, you were going to answer.
I mean, I really don't want to, but here's what I'll do. I will say, what I will say is that there are some investors that are actually attending this conference. And I think those are smart investors because they're taking the time to, and these are public market investors where they cannot, and there's some exceptions, but they cannot invest in most of the companies here. But these are the kinds of people that, because like you're saying, you don't have like a huge universe of education technology companies, and frankly, in a sort of a related point, it's a little bit of a diffuse definition too, because like I said, I call it human capital technology because is LinkedIn an education company? It sort of is now.
Yeah. I was going to ask you that question, but it is, right?
Is Workday an education company? I mean, they don't have they're building out their learning platform. I actually think Workday is going to become one of the most relevant companies in our space because I think they have a single database. They're going to have the ability to tie specific learning outcomes to specific business outcomes. I think that's going to be very powerful. I can promise you that most people who are invested in Workday don't know, and no offense to anyone who's invested in Workday, that's not what they're focused on. They're focused on the company's finance package and whether that's going to get the same kind of traction that the HCM package has. So, so I would say that the ones that are smart are the ones who are taking the time to really understand at a deep level what's going on in industry, talking to the private.
If they're really smart, they're next door listening to McGraw-Hill. So.
Right.
And oftentimes they're the larger, better capitalized asset management firms that have the budgets to attend conferences like this, to look for the next emerging industry that doesn't exist today on the street. So a lot of the larger analysts are out here.
I think the one thing that is true is that you do have with the new models, the companies that have, sort of respectable multiples, you do have the sort of the growth-oriented investors that are looking at them. I think a lot of the legacy companies are really bouncing around in the hedge fund land. And the hedge fund guys are super smart, but they tend to be looking in terms of trades more than in terms of sort of long-term investable themes. Yeah. So, there's a little bifurcation there.
You mentioned LinkedIn, and I talked about LinkedIn last night, and Workday, completely agree with that. Are there any other companies that aren't considered in the education or human capital industry today that look like they're going to be major players? Any companies that pop up?
Are they going to be major players?
It's going to be an important part of their business that you see.
Yeah. So I think you're getting this because of this thesis about the wall breaking between education and the workforce. I think there are a lot of larger companies that are looking at acknowledging that theme and how do you do a better job of measuring what your people know. So because of that, I think you're going to see more and more of the large human capital players getting involved. So these are like the Oracles and the SAPs, where it's pretty, it's not the core of what they're doing right now. But I think as it works for Workday, and as you see some of these more successful, to see LinkedIn acquiring Lynda, for example, or I think Pluralsight, for example, a very visible company. When people see kind of how that model can work within the enterprise and how that it improves your retention and improves your business outcomes, I think that opens their eyes. So I don't think any of them are doing it today, but I think you're going to see more and more of those kind of legacy ERP types getting involved.
Any thoughts?
I mean, I'll say it. I mean, I think, Amazon definitely sees the consumer opportunity in education, and they've dabbled in it. And I think that, that's a big company that could make a big difference, certainly in developing a consumer K-12 marketplace. I think everybody wants to know. I'm sure at least 3/4 of the people attending the conference are really keen to know what Google intends long term. I mean, it's very clear. My kids have no clue from Excel and Word, right? It's Google Apps. That's, and so they're already in schools. The schools my kids go to all are Google, customers. And I think if they wanted to tomorrow, they could be a serious player on the on the LMS side, on the on the school platform side. So I think everybody's sort of waiting to see what are their intentions. Are they gonna they're gonna make a play here or not? I don't know.
Yeah, I already argued.
It wouldn't surprise me.
I'd already argued that Google is an education company.
Yeah, right. I mean,
but any event. So talk about the event. So you guys are here, and I applaud you for being here, because I agree. I mean, if you're an investor in education, how do you ignore? You have to connect. You call something public, you call something private. What's the difference? They're companies. So what are you seeing here that is most interesting to you? Either in terms of specific companies or trends that as you're trying to see different things emerge?
Well, we're seeing a lot of companies. We're very busy the last couple of days, that's for sure, with individual meetings with new and promising companies, tutoring companies, corporate training companies, companies that might be public companies in the next 12 to 24 months, companies like Pluralsight and General Assembly I spent some time with. Wyzant was very interesting. I was particularly interested in Wyzant given my coverage of Chegg, and Chegg owns a business called Chegg Tutors, which is small but fast growing. I was very interesting to meet with the publisher that I met with this morning, Cengage, to see what they're doing in the digital area. Nearly half their business is now digital, and they are very focused on growing that part of their business. It's not so much textbooks anymore. It's not so much e-textbooks. It's really courses of study. It's like it's a cloud-based website sort of thing that includes a textbook. So how education's changing that way. I look forward to spending a little time with McGraw-Hill Education on this trip. You know, they have filed for an IPO. They're in registration. We'll see when that comes. The fact that Houghton Mifflin is doing well and you know, should lead to a successful IPO there at some point as well.
What are you seeing, Corey?
At the risk of preaching to the choir, first of all, I have to say that my compliments and appreciation to Mike, because this conference, I think I'm one of, I don't know how many people there are, I've been at every one of these, from the first one at SkySong. This conference has historically been one of the single most productive things I do every year.
Do you want to repeat that statement, please?
Get that on video.
Yeah, it is. I find it to be unbelievably helpful. The number of relationships, direct relationships that I've started at this conference, the number of indirect relationships where, you know, every meeting try to have some productive result and, you know, kind of introductions that result from this conference. It's been enormously helpful over the years. And this year, it is also, speaking of post-traumatic stress, it's a little bit of, I do meetings every day starting at 7:30 and then go through dinner like 10 p.m. So there's a little bit of what was most productive I probably won't know for about a week when I sit down. But what I can say is that there's a lot of interesting things going on in the learning analytics space. I'm hearing assessment as a theme a lot, and probably in a more technology-driven way. So not just kind of a paper, you know, what do you know sort of thing, but how do we really measure what students know? To me, that's based on the meetings I've had, that's this year's holy grail of, you know, not how do we, maybe at earlier conferences it was about how we lower the cost, or how do we make the learning more adaptive. This year I'm hearing a lot of things about measurement and, you know, how do we know what our people know, and then both in an institutional setting as well as in a corporate setting, and then how do we direct remediation or intervention to that.
What about you, Trace?
I go back to that, you know, there's a whole new world that's opened up again in terms of this space between education and employment, and it's just, you know, the things that are blossoming out of that, whether they're sort of data-driven. I mean, I think Burning Glass is incredibly compelling technology and company, and, you know, there's just a giant problem to be solved there at every end of the equation, right? From the, you know, from the affluent kids that are graduating from the liberal arts schools, you know, but down to, you know, the much bigger issues of, you know, how are we really going to direct people towards employment? So the stuff that I've heard, you know, that, I mean, that has been a theme for a couple of years, but to me that's really, it feels like that's exploding. And I put the boot camp phenomenon in that space as well. But what's encouraging to me is that in addition to coding now, I'm starting to hear about all these other verticals that are growing up that are similar, that are saying, listen, we know education works, we know education is valued, we know we can do a good job of this. You know, post-secondary's got its own issues, but hey, here's a product. We'll teach you stuff you want to know, and this stuff that we teach you is going to help you in your career. And that's always been at the essence of what's been investable in this space. And I just love that there are new people continuing to put capital to work and attack that problem in new ways. It makes me hopeful, and I think it's also inspiring to the traditional for-profit post-secondary guys, because they see that too. And, you know, whether you can argue about whether that was an opportunity that they missed, I think it probably was, but they're also getting inspired by it and adapting their businesses in response to it, and I think that's a good thing.
So can I add one? I met with Coursera yesterday, and you know, everyone's heard of Coursera, and MOOCs were big in the news a couple of years ago, and I was really surprised and excited to learn what they've done with their business since then. You know, it's not only do they have 18 million users of their system, not only do they have 1,800 courses that you can take for free, it's this whole idea of certificates and specializations and credentialing. They have a real business model now that's generating real revenue that ought to, you know, quintuple over the next few years and be a company of size, you know, that can make it to the next stage, I think. I really find exciting what they're doing with the University of Illinois, the IMBA, being from Chicago. You know, University of Chicago has the University of Illinois has the EMBA, the Executive MBA. Now they have the IMBA. And you can get a complete MBA through Coursera for $20,000, which is a disruptive price point for a high-quality MBA.
And if a public market investor wanted to invest in a company that had exposure to Coursera, who might they be able to invest in?
Well, in my opinion, a big portfolio holding of GSV Capital. Yeah.
Yeah, you're invited next year too. So, any other so we mentioned General Assembly, you mentioned Pluralsight, we mentioned Coursera, we've mentioned sort of trends and themes. Any other private companies that you're seeing here that really got you excited? You just can't wait till they go public.
Yeah, definitely. Good luck. Here you go.
Remember, most are not going to go public. We all know that. You know, most are going to end up in an M&A sort of transaction, but there will be some, and that will result in better valuations for all of the companies in the group once there is a group to invest in and more data points to draw a line through.
Yeah, I mean, I'll mention just and this is in no way exclusionary to others, but we actually hosted an event focused on content talent development technology in November. So I think all or most of those companies are here today. So I agree that General Assembly is doing some really interesting things. I think that there's a lot more going on at that company than just kind of the boot camp. I think they're not. I think they don't like the term boot camp for good reason. So I think Burning Glass is extremely interesting. I think that is unique. And as you talk to other companies in the space, Burning Glass probably comes up at least as much as any other as far as reasons to be partnering in the value of the data, the uniqueness of the data that they have. I think that's powering a whole bunch of applications throughout the space. I'll mention a company called Degreed that I'm a big fan of. They are doing a lot of interesting things in that measurement space, kind of how do you measure informal learning and everything that your people know, and allow people themselves to kind of track what they know, so it's not just about having a single degree. I think Parchment is also doing that's, which many of you may be familiar with. It historically was kind of a repository of record for traditional credentials, but also doing some things with moving toward non-traditional credentials. So those are a few.
I would say, Mike, that, and I'm not expert in this at all, but I'm looking forward to it. So you guys are featuring this year a whole slate of private Chinese education companies. And I know because I am at this sort of global platform now, there's enormous excitement for ed tech in China at the moment.
There's a lot of people in China.
A lot of people in China. There's the investors have really woken up to the potential for tech and education over there, and they're hungry for information, you know, on sort of what's worked, what hasn't worked in the U.S. markets, and so forth. So there's a whole slate of private companies that I'm guessing are going to be pretty exciting to hear from.
Unbelievably exciting.
Yeah. So I would plug that. I'm looking forward to that myself.
So as research analysts, you guys are excellent at responding to questions, but you're also really good at asking questions. So if you were to ask yourself a question that I should have asked but didn't ask, what would that question be? Since you look the most puzzled by the question, Alex, I'm going to ask you first.
Trying to think it through. You know, there's some easy questions that we research analysts ask, like what keeps you up at night and what haven't I asked, right? You know, but you know, I suppose we didn't talk about the state of the IPO market, you know, today. You know, the IPO market's been quite weak. Should I answer my own question, or?
No, you ask us. That's it. What questions should I ask? If I was a really good interviewer, what should have I asked you that I didn't ask you?
So you know, everyone knows, reading the Wall Street Journal or watching business news, that the first quarter was a really bad quarter, you know, for IPOs. There were no IPOs. And the IPOs
there's actually 8, but there wasn't any real IPOs. But keep on going.
Right. And again, I'll defer to the expert on that. And the slowdown really started in the fourth quarter with the volatility in the market. So what's it going to take to have IPOs start coming again? We just had a recent IPO of the BATS exchange, which was positive. It was upsized. It was priced above the range, and it traded to an immediate premium in the market. That's the first step. You know, the two things you really got to look for is stabilization and an improving overall market and performance of recent IPOs. And I took a look at that last night, preparing for this, not knowing what we were going to be talking about. And you know, from the February trough, the S&P 500 is up 16%. The Renaissance Capital IPO ETF is up over 60% over that same period of time. So that would imply better things for the IPO market going forward. We had a successful BATS IPO, as I said, and we're cautiously optimistic that we'll see more IPOs as the year unfolds.
Either of you. Go ahead,
I don't know
Trace.
if it's a question, but I was going to say one of the things that's been a little bit insidious in this market, and again, this is an area where Mike's going to be way more expert than I am, but One of the things that's happened over the last, I don't know, 5 years or 5+ years is that we've had this new phenomenon where companies that would otherwise have gone public in the old days are now going to public market investors and seeking a sort of a final round. And that's a whole slate of companies that would otherwise be in the public markets that public market investors will be looking at. And I think we had the news yesterday, this week or the end of last week, it looked like Fidelity and T. Rowe both wrote down a bunch of those investments, and it kind of made me wonder if, well, you know what, maybe these guys will think twice about that. Maybe we'll actually, ironically, kind of create a new renaissance for public market, investing, and maybe the testing of the public markets is a good way to do that. I would love to see that happen, because there are a lot of companies that go through that process that would otherwise already be public companies, right?
Mm-hmm. I guess the question I would ask is, what do you think this ed tech market looks like 5 years from now, or something like that? And my answer to that is, I think you are going to see, eventually the markets. It's interesting because the IPO markets are sort of closed, but at the same time the markets are actually recovered pretty nicely. So at some point here, you're going to see more companies come public. I think that there are a number of companies in this space that are going to make very good public companies. I think that's going to be beneficial for the entire market. I think you're going to see more of this. You're going to see some very successful pure play ed tech companies. So I am bullish on the ones that we talked about. I think that, as 2U and Chegg get much larger market caps, that'll be helpful for other companies in the space, both in the public and private markets. I also think you're going to see more kind of ed tech companies talking about kind of human capital technology. And it was important to Instructure when they went public, even though most of their business is in the K-12 and higher ed markets, to at least have a product in the corporate markets and starting to get traction there, because it expands the addressable market opportunity. So I think you're going to see more kind of ed tech companies doing things in the corporate markets as well, for all sorts of reasons. So I think 5 years from now, you're going to see more public companies. I think you're also going to see some shakeout. I think there are a lot of there are private companies that you're going to see some get swallowed up by some of these larger companies. I think you're going to see, you do have a number of companies in the space that have a very interesting and compelling technology, but it's difficult to attract enough capital to scale the distribution to make it work particularly if you're focused on kind of the traditional education space. So I think some of those will get swallowed up or fall by the wayside, and I think you're going to see a number of very healthy winners in the space.
Okay, so last question, and it's going to be tight. Tell the audience something that they don't know but should know to be successful in investing in the ed tech space. And Trace, since you look at the most bewildered, I'm going to ask you first.
Yeah. It's kind of old school, right? I think, what's the business model? How does this company make money? I think that a lot of the build it, they will come, get the traffic, and the rest will take care of itself. That's really common to tech. I don't think applies in this space in the same way. So the question I would say is, how are you going to make money? And if you figure that out, and you maybe need to figure that out sooner than you would if you were creating a social media platform.
Corey.
If you are selling into traditional institutions, K-12 or higher ed, distribution is the toughest problem to solve. Even though you got to get the technology right, but distribution is the toughest problem to solve. Nail that cost of acquisition, particularly if you're acquiring specific students. That's the toughest challenge to overcome. And find ways to stay focused, but find ways to expand your market opportunity.
Alex.
I just want to build on what Trace said. I agree with that. Profits are what is important in the long run. Obviously, if the out is to grow the company to $10 to $15 million in revenue and sell it to a bigger company with scale, that's less of an issue. But if your plans are longer term, profits are important. Take the 3 public companies that are already public. They're constantly focused on talking about profitability. 2U went public, said they'd be profitable in 3 to 5 years. They felt the need to tell the street that they're going to be profitable earlier than that in 3 years. Chegg just crossed over profitability in the 4th quarter and expects to be profitable on an adjusted EBITDA basis in 2016 and beyond. And Instructure's already given good guidance for a profitability point in 2018. So they're all talking about profits, not just revenue, even though that's how we value them today.
And just before I close, I just saw in the room one of the great all-time education research analysts, Jerry Urdan, so you got to acknowledge him as well. But please give it up for the panelists. Thank you.